So it's almost impossible to say that order blocks are not a crucial part of every smart money trader. And in this lecture, we're going to discuss what order blocks are, what validates an order block, the best time frames to map order blocks, and how to define entries, stops, and exits when trading off order blocks. So before we get into the real thing, I'd like to invite you to join my course, my free course called The Fortunes Blueprint. So this course basically has everything you need to set you up as far as technical analysis is concerned, and there is a mentees group where I basically hold weekly webinars with members of this mentorship. It's absolutely free, and just in case you're interested in getting weekly forecasts and trade ideas, I also have a free Telegram chat. The link is also in the description. What is an order block? Now, an order block is a price range delineated by a candle where smart money have performed their last buy or sell transactions before pushing price in the opposite direction. So that's to say that a bullish order block is the last sell area before a move upward, and a bearish order block is the last buy area before a move downward. So just like we talked about in the Understanding Buyers and Sellers Territory lecture, a valid order block must be responsible for the break of structure bullish or bearish. Now, this bullish or bearish break signals the willingness of price to continue higher. And in this example, we have a bullish order blocks, we have an impulse, a retracement, and an impulse causing the break of structure to the left, indicating the willingness of price to continue upward. And this guy responsible for supplying the momentum that causes this break of structure is your bullish order block, because this is basically the last area where smart money have carried out all their sell transactions before pushing price in the opposite direction. Now, the best time frames to map order blocks are simply the daily, weekly, and monthly, and the idea when mapping order blocks is to use higher time frames because they have the most reliable structure with less noise. Now, once you have identified these higher time frame order blocks, the idea is to switch to a lower time frame and wait for structural breaks in line with the prevailing trend, which I'll be showing you guys in a minute. So next, we're going to look at some real chart examples before actually explaining how to define entries, stops, and exits when trading order blocks. So here you can basically see a few trades. I have a few screenshots of trades that I've taken in the past basically to show you how these order blocks work. Now, I want you to ignore the time frame. So you can see here that you had a change of character here. That's to say price was moving sideways for a while. You see an impulse breaking the structure to the left. Now, this is basically price telling you we're switching from a sideways trend or for a downtrend into an uptrend, and you can see you created a high here, a pullback into that area that you had the order block that was responsible for causing this break. Okay, so ideally for entry, you want to map the whole range, and then you can use the open as an entry and the close of the candle just a few pips below the candle to factor in for spreads. That will basically be your exit. But here in this case, the trade wasn't taken immediately here because this wasn't a break of structure really. This is more like a change of character, signaling that the trend is about to continue in its original direction. We'll go into the daily time frame soon where I'll show you guys how I map these order blocks, but I just want to use examples from trades that I've taken to show you how I define entries and exits for order blocks. So you can basically see we had another break, but this is basically not really the guy that started the move. This remains the origin of the move, and you can see price trade back into that area. You can see some sort of confirmation pattern here, and the last area where the sell transactions were carried out, as you can see, this is the last bearish candle here before the move upwards. So what I mean by the last area is simply you take the whole range of the candle, so that area is going to be your order block, and then the open would be the entry and the close would be the exit. So you can see price come back into that area, and then you can see a bullish move for about a 1:4 or 5. Now, if you look to your left, you can see another break of structure, and who is the guy responsible for this break of structure? The last sell area. That's the people responsible for pushing price upward. And then you can see price comes back, taps into this area once again, entries around the open to the middle, and exit was a few pips below the whole range, and then you can see price moving all the way up for a very quick 1:10. Now, in as much as this was done on a 5-minute time frame, the whole thing requires a lot of experience. So I'm not saying this can only be done on the higher time frames, but I'm just trying to explain to you that I'm just trying to explain entries and exits as far as order blocks are concerned. Now, for exits, which is basically your take profit, you want to look at the structure to the left. Remember, we talked about liquidity pools. If you haven't seen that, you want to refer back to the course and go through the lectures to find that one. So liquidity pools are basically strategic areas on the chart where you have resting liquidity in the form of buy stops, sell stops, and stop losses. So you want to target those areas because more often times than not, price will most likely gravitate to those areas to take out those liquidities. So that will be basically where you're looking to offload some of your orders. In this example, you can basically see that you have price coming all the way down. You have a break of structure to the left. This is an inducement of this low. Now, this is the area where you have the last sell activity before a break of structure here and another break of structure here. So you can basically see that my entry is within that order block range, and the stop loss space placement is below this range. Okay, very simple. Now, the exit is in and around another order block that I think might continue to push price lower. Okay, and this is also an imbalance. Like I said, if you're not familiar with some of these terms, you want to refer to the course. The link is in the description. For this example now, you can see price was trending all the way down, but we were actually trending into a higher time frame bullish order block. So you can now start to see that we had an inducement of the low, a break of structure, a break of structure. Price is now trying to tell us something. It's trying to say we have to move upwards. This is the last sell area. This is the last area smart money have carried out all their sell transactions before pushing price upward. And as you can see, the impulsive candle down, and the next candle actually took out liquidity from below that candle, and you can see the impulse breaking the high of that candle, and that was where I was anticipating a buy. Unfortunately, price didn't really come into that area, but then it was really close to the open of this last sell area, and you can see price almost hit our take profit to the T. Another example here, this is an example on oil. You can see that we are in a bullish trend. So this is on the 4-hour time frame. This is an example of mapping an order block on the higher time frame and then scaling down to a lower time frame to look for entry. So this was basically a daily point of interest. So I had to scale to the lower time frame to wait for a structural break in the direction of the prevailing trend. Now, what do I mean by that? In as much as price is trending upward on the daily time frame, you'd start to see this little breaks of structure on the 4-hour time frame that is making you feel that we are in a downtrend. Okay, now what I want you to understand is this whole range from here and here is internal range liquidity. So what you want to do is be able to identify these points of interest and then offload your orders in external range liquidity. This was a really profitable trade for me. As you can see, when price came into the area, we had a reaction, and we actually hit take profit. I think this trade, I posted it on Instagram and it was shared in the free Telegram chat as well. Another example you see here, you would find most of my entries on the lower time frames because I refine these daily points of interest and transpose them into lower time frames, and I still look for the same patterns and I take my entries off of those areas. So this is an impulse here, you see breaking structure. This is the last sell area. You can see the impulse here to show you that they've successfully manipulated all the people that were selling with them. This is the structural break you want to wait for. This is an uptrend, but this on the 1 minute would perhaps look like a downtrend, so you want to wait for structural breaks trade. Okay, so let's go back into the charts and I will show you some of these examples on a daily time frame. So for this example, I'm going to be using oil. That's not to say oil is the only pair it happens on. Basically, it happens on a lot of time frames, different time frames, and I'm in different pairs as well. But I'm very much interested in oil because I trade oil a lot. So you can see that we had the move all the way down here, and what you see is this was the last sell area before this whole move up began, and this would basically be your order block. Now you can refine that order block to be this candle here, simply because momentum came into the move after this candle was printed. Okay, so this would be your higher time frame point of interest. You can see again that we have a strong move upward. This was the last area they performed all their sell transactions, as you can see here. So just like here, before this whole move began, this was the last area they performed their sell transactions, and you would be correct if you say this is the your trading range. And if we go into the future, price may basically react to that point of interest. That is basically what I think. I currently have a trade as well. I'm expecting some sort of bullish reaction here, though I feel price may come all the way down here, but I think we should move back into this order block that pushed price lower before we see a reaction here and maybe continue to the upside. So you've identified these order blocks on the higher time frame, right? So you can switch into a time frame like 2 hours, and we're going to go back in time to see how price reacted into that area. So usually order blocks are supposed to be a specific candle based on the definition from orders, but I like to see that as a price range, because if you were to say you were going to refine this to be a specific candle, you basically would see that price didn't trade into that area you would have refined, but then you have a bullish confirmation entry here, and then you see once again the price broke the structure to the left. Who is the guy responsible for breaking this structure? This is your order block here, the last sell range. And what do you see? Price reacting to that area. And just like we talked about, this is the high where liquidity is. And if you had taken this area here as an area for entry, stop loss below, a few pips below the low, and offloaded your orders at the high, this would have been a quick 1:2.5 trade that you would have caught here. So you can basically see that the concept actually holds true. You have a break of structure here. Where is the area that started this move? This is basically the area here. This is your last sell range. And what do you see once again? Price dips into that area. If you had taken this for a buy, stop loss below here, then take profit will be above the highs again. Now you have other highs here as well. That is liquidity. This here also is liquidity, and you would have been able to catch a quick 1:3.72 for a quick one, or perhaps held for even higher targets to give you a 1:5 or 1:6. Okay, very, very easy. Now you can see once again you have several breaks of structure to the left, and who's the guy responsible? This is your order block range. This is the last sell area here where smart money have performed all their sell transactions, inducing and trapping traders short and pushing price to the upside. And you can see we have another bullish entry confirmation long. If you had taken this trade with a stop loss below this level, just to factor in the spread, where are you going to offload your orders? As usual, the highs here, because these are liquidity pools. Okay, and you can basically see that would have been a quick 1:5. Okay, as you can see, that might have taken a while, but then price would have eventually hit your take profit target for a quick 1:6. So you can basically see that these concepts, now even if you decide to take these concepts on a lower time frame, what do you see here? Break of structure, a return to the last sell area. What do you see? Boom, another break of structure, break of structure. Where's the guy responsible? This is the guy here. This is the last sell area, bullish entry confirmation long. Now you can basically see the reason why we needed to lay those foundations. We're trying to understand buyers and sellers territory, because you can see that the area that is responsible for keeping us in the buyer's territory is that same area where smart money have performed their last buy or sell transaction. So we've come to the end of this lecture, and I will see you guys in other lectures. By the way, if you haven't joined the free Telegram chat where I share trade forecasts and ideas, the link is in the description. And also, if you want more in-depth explanation on how to tie this together and other concepts as well, you want to look at the course, the link is also in the description. And I will see you guys in another one. Peace out, guys.